Is off, I'd like to talk a little bit more of some of the technical investment tools that investors have in their pockets to make sure that their money is not only earning what it needs to earn in order to make their overall financial plan successful, but also make sure that they're managing for risk along the way. And so one of those tools is what's called asset allocation. And essentially what that is the process of splitting up investments in a portfolio among different asset classes. So stocks, bonds, sometimes cash and money markets, or even alternative investments like real estate or commodities even. And so the goal is to put it simply, is to spread your dollars out across different investment categories in an effort to balance risk and reward based on your individual goals, risk tolerance, and time horizon. So, based on your circumstance, not based on the circumstance that happens to be present and going on in the financial markets. So, an asset allocation model should be built on you, not what's going on with all these external uh, factors. And so we've got a chart here of six different investment types, along with some pros and cons. I like to say, opportunity and risks. And so, just to give you a brief overview of the common types of investments that most investors use, starting with stocks, what you're buying with a stock is an ownership interest in that company. And so you're generally buying that stock because it pays a nice dividend and you're buying it for the cash flow of it. And or you're buying it because they produce a product that you think is going to generate sales for them. And if they have sales greater than the expenses they have to produce those sales, that creates profit, and the stock market likes profits, and that's what drives the that stock price in a positive direction. Some risks that are apparent with stocks is that it's non-diversified. So typically, if you're buying one or just a couple of stocks, um, it can lead to a lot of different fluctuations, sometimes based on what's going on at that company, sometimes based on external forces like tariffs that we've seen here, recently. So in a stock portfolio, there, on the downside, there can be quite a bit of risk associated with that. Bonds are a common investment tool as well. Believe it or not, the bond market is actually bigger than the stock market. It just doesn't get quite as much attention because bonds tend to be a little bit more boring than stocks. And so when you buy a bond, what you're doing is essentially loaning money, typically to a company or a government, in the case of like a US government treasury, or a municipality in the case of a municipal bond. And so when you have a bond, what happens is you loan that money to that organization for a period of time, let's say 10 years. All along the way, they're paying you interest. And at the end of that period of time, the intent is for that organization to give the money back to you. So it basically works like a loan. There can be risk of default. So if the um, company, in this case, that you lent the money to doesn't have enough income in their business to repay you, they might default and miss an interest payment or potentially even miss an opportunity to pay you back at the end of that period of time. But it is a contractual obligation that they have. And so, because of that obligation, bonds tend to be a lot less risky than stocks. We tend to, one category that we really like is mutual funds. So a mutual fund is a diversified investment pool. You can have a stock mutual fund or a bond mutual fund. You can have a mutual fund made up of real estate or even cash type investments. So they come in all different shapes and sizes. What we really like about them, though, is they're diversified. And so in most funds, you might see anywhere from 50 to several thousand stocks or bonds that make up that one particular mutual fund. So it's a good way to reduce single stock risk and get more broad market exposure rather than buying, one or a couple of different stocks. Um, Nowadays, there are 137,000 different mutual funds and exchange traded funds out there. Some are really good, some are really bad. A lot of them are somewhere in the middle. They're just okay. And so you want to make sure that you're doing a lot of good research to make sure you're buying the right fund. They're not They're not all the same, and some managers have clear, distinct advantages that pay off for investors. A lot of them can be high cost, and which leads to poor performance. So, in the mutual fund space, you want to make sure that you're getting the right bang for your buck. Another common investment type that people tend to use are annuities. And so, in the annuity space, essentially, typically what you're doing is transferring investment risk from the investor yourself to an insurance company. And so, a lot of annuities come with certain types of guarantees for the transfer of that risk. They tend to feel a little bit more comfortable because you're not taking that risk on yourself. But the cost of that is that these investments are high cost. So one of the first things they teach you in an economics class is there's no such thing as a free lunch. And so if you're getting that assurance from the insurance company, it's going to cost you quite a bit in the way of fees and insurance expenses associated with that annuity contract. They can also be somewhat illiquid, meaning they lock your money up for a period of time. So it's not to say that they're not appropriate. You just got to make sure, again, you know exactly what you're getting into if you're looking at an annuity. Cash, believe it or not, is a form of investment. That's pretty simple. No risk, also not a lot of return. And so cash can be a placeholder inside of a portfolio, but typically it's not something that pays enough in the way of return, specifically after inflation, to provide an adequate source of return for a long-term retirement portfolio. And then finally, real estate. So there's a lot of opportunity in real estate. You have to be really careful, though, about the type of real estate that you're buying. And any real estate investor will say the money and the return is made on the purchase price. And so you want to be careful at what price you're buying. Are you buying investment real estate to hold and rent? Are you buying investment real estate to potentially flip? A lot of different structures out there that you can get involved with. But just have to be really careful because a lot of times real estate could be, somewhat illiquid. It's not very easy to turn into cash, or in order to do that, it takes a lot of cost. Paying title companies and real estate agents and management and upkeep of a property are all costs that add up and work against your return. And so, thinking about all these different types of investments that are out there, really what I want to drive home is that there's no one strategy that really is a perfect fit for everybody. Typically, it's a blend of different types of stocks or bonds or stock or bond mutual funds that and most investors are using to build a uh, retirement portfolio. And so when you're considering what asset allocation is appropriate for you, what you really want to do is consider more than just your 401k. You want to consider all of your assets, like a pension lump sum, your cash savings, investments outside of your 401k. Maybe you have some brokerage account investments. Um, Maybe you have some IRAs or Roth IRAs out there. So you certainly want to consider all of those items, but also income sources, because those income sources will ultimately determine when you're going to need the money inside of your 401k and other assets to live on in retirement. So, um, as you think about your own personal retirement plan, maybe you're planning on working part-time in your retirement years, or um, you have some Social Security income coming in eventually. Perhaps you or a spouse have a monthly pension that needs to be factored in, or rental real estate income. And so all of these factors should play into a retirement plan that can help you to determine where your asset allocation lies. But in general, the thinking is higher risk investments should be reduced as you get closer to retirement, simply for the fact that you don't want a singular market event to either delay your retirement date or significantly impact your retirement if you're already retired. So, for example, back in 2008, from peak to trough, the stock market dropped nearly 60%. And if you had too much risk or a lot of risk inside of your portfolio, that would have some pretty drastic consequences. Now, fortunately, in that example, the market rebounded relatively quickly. And then we've had a few ups and downs over the years, but really over the last 17 years, the market has been on a pretty positive trajectory. Had we not had a significant market recovery right away, a lot of people that are taking too much risk in their retirement portfolios would have had to make some drastic adjustments. Meaning, if you're already retired, significantly cutting your retirement income from your portfolio, or potentially going back to work part-time in some way, shape, or form to make up the disruption that like an all stock portfolio might have had on somebody's retirement plan. Or if you're still working, it could have been, hey, I might need to work another 3 to 5 years to allow my money to recover. And which is good if you have that option. Sometimes, though, as we all know, retirements, even though they may be well planned, sometimes retirement is forced rather than an option. And so all these reasons are reasons why it makes sense to reduce the level of risk that you have inside of retirement investments as you get closer to that retirement date. And so the nice thing is that we can scientifically measure this. There's a study out there called modern portfolio theory, and what it looks at is the return that's expected for a given unit of risk inside of a portfolio. So all bonds or all cash traditionally would be the most conservative type of portfolio that one would have. And then an all stock portfolio would be something that involves the most risk, but also over time typically allows for the most return. And what modern portfolio theory says is that if we look here kind of in this 50-50 or 60-40 category here, we actually get about double the return that we can get of bonds without taking a whole lot of additional risk. And so in our opinion, working towards that level is kind of a nice spot to be. It's a sweet spot, if you will, for somebody who is in retirement or certainly getting close to retirement. You can, in other words, maximize the level of return that you're earning while minimizing the level of risk that you have. So that's more of an academic study. The nice thing is we can actually take those same factors and apply them to your personal situation. So, as we've gotten to know over the years, new people that come to us asking for our help with what they should do with their investments, usually that's kind of the first question. Prior to even getting to a point of, hey, you should do X, Y, and Z with your portfolio, our suggestion is that we actually go through a financial planning exercise because it helps us define for your particular situation, what is the right asset allocation for you? So I mentioned earlier, considering all of your assets, all of your income sources inside of your household, where should we fall? And we can actually look at based on your facts and circumstances, different types of investment portfolios, and define very clearly the level of risk that's necessary for an investor to take in order to be successful, both in the short and long term, in terms of meeting their retirement funding goals. And so one of the ways we do that is by running a Monte Carlo analysis, which is what you're looking at here on the screen. We can see this is just an example, but we can see for this particular person, a very conservative portfolio would have been a terrible idea. Feels good because there's not a lot of risk. The return is relatively stable, but in this case, this person was not able to meet their retirement funding goals very well. And so looking at this percentage that says 51%, that would give me cause for concern because essentially what that's saying is it's likely because you're not earning enough return with your money, you're going to run out of money before you run out of time, which is not a good outcome. We also looked at a very aggressive portfolio, um, came up with an 85%, so much better than the conservative portfolio, which is fine. But if we look all the way on our left, we take a more balanced approach. We actually increase our retirement security and reduce risk. So thinking about that study that I referenced to finding that sweet spot, in this particular person's case, the answer was, hey, let's take a more balanced approach because we can increase your retirement security, lock that in with a more appropriate portfolio from a risk perspective. So the good news for all of you is that going through that financial planning exercise with us is a complimentary service that we offer for everyone who works at AT&T. So there's no cost and certainly no commitment. It's just an opportunity for us to serve you and offer some initial guidance. So if you're interested in that, please feel free to reach out to us.